Hello students and welcome to Chapter 8. For this chapter, the videos that come with this chapter include all of the learning objectives except for 3, 5, and 7. So I wanted to go over some problems related to just those 3 objectives for this chapter. And the way I'm going to do that is just to go through the 3 problems that are included in your PowerPoint, which you should be going through. But I thought I'd just give a little bit of extra explanation for those. So starting with learning objective 3, describe and apply different approaches to pricing. So I'm just going to skip through until we get to the exercise that's given here, which is, just one moment here, exercise 8-20. And if you want to, you don't really need to look in your textbook because it's given right here for you. It is in your textbook, of course, if you want to look at it further offline later, and that is on page 483. So you can look at that on page 483 in your textbook if you like later. So this would be a good time for you to pause this video and read through all the requirements, the material, and requirements 1, 2, and 3 here. So pause your video now. Okay, so now you should have read all of the material here, and our first question is, which approach to pricing should Preston builders emphasize, and why? Okay, so if we look at the answer here and talk about this, they should emphasize target costing. And why? Because they are a price taker. Their product lacks uniqueness, and there is heavy competition. And of course that was given in all of the wording there in that problem. All right, so going back now and looking at the second question, will they be able to achieve their target profit levels? Okay, so our calculations on this is we take our revenue at market price, which was given, less their desired profit, which was given as 15% of variable cost. So if we add up all the variable cost items that were given, we get $186,000. 15% of that is their desired profit. So revenue less their desired profit gives us our target cost. Target cost being $176,100. Well, our target cost is obviously less than our variable cost. So no, the answer to our question, will they be able to meet that target cost, is no at this point. Okay, then the third question, which is a longer one. I'm not going to read the whole thing. If you need to pause your video again here to read through this again, you can. Otherwise, let's move right through this. So the basic questions, though, given all this information, will the new cost plus price, what is the new cost plus price per home, and should they differentiate the product based on this analysis? Oops, I went too far. Okay, so what we want to do is compare the total current costs given the upgrades with the new desired profit based on the new variable costs to figure out what the cost plus price of the home should be in order to make their target cost. So we have original total cost of $186,000 with the additions that they're going to make, or the improvements would increase the price by $20,000. That was given in the question for a total of $206,000. Our new variable costs are $206,000, and 15% of that gives us the $30,900. So cost plus price is $236,900. So yes, they should customize because they will achieve their new target profit levels with the cost plus price. So their cost plus price being $236,000. And if we go back and look at what would the total cost, total price be for that now, we know that originally they were going to be able to sell them for $204,000. Now they're going to be able to increase the selling price by $35,000, which gives us $239,000. So $239,000, and yes, we will be able to do that with the cost plus price method here. Okay. The next objective that we're going to look at is objective number 5. So I'm going to skip over to that one here. And objective 5 is factor resource constraints into product mix decisions. And the problem that we're going to look at related to this is 823A. Again, of course, this is in your textbook. You can find 23A on page 484 in your textbook. So once again, this would be a good time for you to pause this video and take a look at all of the requirements. Okay, so start your video back up again now, and here are all of the requirements, and they're asking for what product mix will maximize operating income. And then they give you a hint here. Use the allocation of fixed manufacturing overhead to determine the proportion of machine hours used by each product. Okay, so use the allocation of fixed manufacturing overhead. So the fixed manufacturing overhead is allocated on the basis of machine hours, meaning for every $1 in overhead applied to regular, they're applying $2 to deluxe. So it's a 1-to-2 ratio or proportion, right? That's what they're saying here as their hint. Okay, so if we look at the problem here, we have sales price per unit for the deluxe and the regular. Those, of course, were given. Variable cost per unit, and we can find those by just adding up all of the variable costs, which, if we look at the problem here, includes everything except for the fixed cost allocation of overhead. So all of the other items would be included, and that calculation is shown right here as well for our total variable cost to get our contribution margin. Now remember, this is per unit, but remember how many units can be produced with our equivalent number of machine hours. So we know that for the regular it's a 2-to-1 ratio. That was the hint that was given. So for the regular we can produce 2 for every 1 with the equivalent number of machine hours. Okay, so that is telling us then that our product mix would be maximized if we only actually produced the regular ones, because for every one of those we can produce 2 with a contribution margin for equivalent number of machine hours at $262. Of course, you know, there's other things that you would need to take into account here. We're only looking at the numbers. If they were to lose market share and to lose customers because they did not offer the deluxe model, that could be an issue for them. So they would need to look at other factors, of course, than just the numbers themselves. All right, the last learning objective that I wanted to cover is number 7. And that learning objective is to decide whether to sell a product as is or to process the product further. And the number that we're going to look at is 28A. And 28A is on the last section of the exercises in Group A, which is on page 486. And there's a lot of words here, so take a look at this, pause your video, and read through the material. Okay, so now we have all the information we need here. We just need to put it in some logical order. So we can do that by first saying, well, what is our sales revenue per unit? So we're comparing selling it as is versus processing it further. And they give us the information for the sales value, sales per unit. They also give us additional cost per unit in packaging and the additional cost per unit for processing the fruit. And there was no cost with the sell as is in gallons and 10 cents per unit in processing it further. So what is the net benefit per unit? Sales revenue less the additional costs. So the net benefit, but then how many number of units can be produced per batch? So we have to multiply the net benefit by the number of batches, and that tells us the net benefit per batch. Now, looking at this further, it tells us that we should process further because our net benefit per batch is higher if we're going to sell it in the individual units versus in the larger gallon size. Once again, just like the last problem we looked at, there's a lot of things the company would need to take into account. If they're going to lose some market share by not selling other types of the units than just the smaller units, then there's other factors to consider. But just looking at the numbers here, it looks like they should be processing the item further, as the benefit will be higher for that process. That is the end of the items that I would like to cover for Chapter 8. We'll look at Chapter 9 next in the next video and look at some additional problems there. All right, good luck and thank you.